Tesla's final quarter earnings of last year contained some major positives. However, investors had become increasingly bullish on Tesla as the stock had a massive run last year, followed by a run-up to start off this year, and we've seen a recent pullback from the highs, with the stock going from $900 to $600 per share. Analyst estimates had risen significantly, which has set the expectations very high for Tesla, and anything less could cause major disappointment for investors, even though there might not be anything fundamentally wrong with the company. For any public company, there's always a trade-off between short-term and long-term thinking. If you invest for the short term, you will please Wall Street and the stock will be rewarded today. Although the true value may be in the long term, where laying the groundwork today will prepare the company for significantly larger gains in the years to come in a much more sustainable way. Sometimes these two methodologies or time horizons conflict with each other, and it's not possible to do both of these at the same time. For Tesla, it looks like this last quarter, Q4 of 2020, was focused as much as possible on the long term, while still remaining profitable in the short term, even though profitability may not have been as high as Wall Street was expecting. In this video, I want to look at Tesla's income statement and pull in some ideas and explanations from their annual report and explain why Tesla may have missed what Wall Street was looking for, at least for earnings in the last quarter. They made 80 cents instead of $1.03, but while Tesla missed Wall Street earnings estimates, the report may show clues that Tesla was busy laying the groundwork for the long term. So I've put together Tesla's Q4 results in blue and my old estimates that I made before the quarter in red. I can put this spreadsheet up on our Patreon at patreon.com/themarketisopen. Also, we have financial data on our website, themarketisopen.com, going back 9 years for every stock, not just Tesla, and it's all freely available. So I had estimated that Tesla would earn about $9.3 billion just off automotive sales. And I did that by increasing the number of cars sold from 140,000 in Q3 to 180,000 in the last quarter. I used about the same average price, which was $52,000 per vehicle. Now technically that's not the average price because of emissions credits. Also, as Tesla's revenue grows and the emissions credits stay about the same or go lower, they become less and less significant. So Tesla's average price was actually closer to $49,000 per vehicle in Q3, and it dropped closer to $47,700 in Q4. The average price did fall from Q3 to Q4 as Tesla ramps up the sales of Model 3, especially in China, compared to cars like the Model S and X, which are becoming a smaller and smaller percentage of Tesla's overall sales. I think that will slightly reverse itself going forward, as in one case the Model S and X sales I believe will increase thanks to the new refresh to Plaid, and prices also went up. Also in China, the Model Y factory was completed in Q4, and it's now ready to deliver higher priced Model Ys and the most expensive Model Ys first, which may take a few quarters to ramp up. Now this said, Tesla did beat analyst revenue estimates of $10.2 billion by quite a bit. They did $10.74 billion. So for a growth company, that's what you want to see, revenue beats. Earnings isn't as important at this time, as we'll soon see why. But it's interesting that the third quarter is always better than the fourth quarter in terms of earnings, even though Tesla tends to sell more cars and make more revenue in the fourth quarter. And this has been true for the last 3 years. I think part of the reason is that Tesla usually has a major push to deliver as many cars as possible, which is something new that they've never really done before. And so they need to spend a lot and basically build out the capacity to deliver that many vehicles, which ends up increasing spending and hurting earnings in the final quarter. The other thing to notice is that about 9 lines down on this spreadsheet, the cost of automotive sales is even higher than my estimate, which I used the same cost per vehicle from the last quarter and just adjusted for more vehicles sold. So costs to produce vehicles were actually a bit higher than that. One reason that may contribute to this were higher shipping costs and logistic costs, which Tesla says shows up in this account. You can check out my Tesla Q4 preview from earlier this year to see how I came up with all of these estimates in the first place. Now let's look at energy generation and storage, which shot the lights out far above last quarter and far above my estimates at $750 million. Now that's great and contributes to revenue, except that if you look at the costs for energy and storage, those were actually above the value for sales. So Tesla lost money on that, which is odd for Tesla because normally they are slightly profitable for energy. According to Tesla's annual report, one of the main things they talk about that contributed to higher costs was a temporary underutilization of manufacturing as they ramp up products like Solar Roof. Tesla is changing their solar strategy up with more affordable products, and so I think it's a momentary loss in order to help lay the groundwork for next year when Elon says that the Solar Roof will be a killer product which will become obvious next year. Services are also in a similar situation where they lose money, nothing new for this division, but the losses were a bit higher than usual. Tesla is continuing to put up service centers as fast as possible. They also have their mobile service fleet that's ramping up. At the same time, as Tesla's fleet grows and gets older, there are more cars coming off of warranty, which helped offset losses here. So again, Tesla is laying more groundwork for the future, so they're taking a short-term hit as they sell more vehicles. And as they sell more vehicles, that can help provide more maintenance revenues in the future, although Tesla never wants to have maintenance as a profit center for the company. Okay, so if we add all that together, Tesla made $2.06 billion in gross profit, almost exactly the same as the third quarter, selling way more vehicles, about 28% more, but mainly there were higher costs in multiple areas. Some I think are temporary, and some are laying the groundwork for the future. So in this quarter, they are in fact spending a lot more money. Okay, so moving along to research and development. Now we're starting to see that Tesla is spending a lot more to advance the business. Surprisingly, R&D shot up to $522 million. So why is that? Well, Tesla hired way more people. I mean, they are continuing to expand their factories, and they have to hire a lot of people to fill 2 new gigafactories in Berlin and Texas sometime this year. It's impressive actually that Tesla is still profitable even while ramping up all of their products and trying to double the size of their company by doubling the number of car-producing gigafactories. Tesla states that part of the R&D costs relate to expensed materials as they try to expand the product roadmap. The cost of prototyping, for example, is something that would appear in this category. They also had higher stock compensation expenses because the stock price was higher, and they did have higher expenses for facilities and freight and depreciation throughout the year, which may have had an impact in Q4. Next, we see that sales, general, and admin increased as well, but not actually that much. I think they maintained that quite well despite some headwinds. I was forecasting for a much larger expense, and Tesla managed to keep costs down. The CEO Performance Award had an impact on Q4, that's part of this. Things related to selling, sales, marketing, HR appear here. So I think the stock compensation hit this account pretty hard, temporarily though, so it's not going to be a big deal going forward. So again, these increased expenses in R&D are taking away from short-term profitability despite setting the company up for the long term. And SG&A is actually really well managed despite being temporarily elevated in costs. Now, continuing with interest income, that was the same, but interest expense really hit profitability this quarter, but I believe it's related to extra expenses with paying off some of their debt early, which is a good thing long term. I do think that interest expense may increase a bit in the future when they start producing cars at their new factories. Now, their other income category is related to some gains on their foreign currency exchange, nothing that's really too exciting or related to the core business. Of course, the amount of money that they need to put away for taxes doesn't need to be as high if Tesla doesn't make as much money. It's worth it to spend like crazy to keep gaining market share and move quickly to have a larger market opportunity in the future. Their tax rate did go up a lot this year. For the full year, it went from negative 17% to plus 25%, and last quarter it was 33%. So as Tesla gets to be more profitable, the tax rate will simply grow. In total, they made slightly less GAAP profit compared to the previous quarter, 24 cents versus 27 cents. Really, profit should have been much higher, but Tesla is pulling an Amazon, where it's more worth it for them to disregard Wall Street's short-term outlook and invest in the future. Tesla is spending like crazy, and we did see big revenue beats, but hopefully analysts will temper down their earnings estimates as Tesla is still in major growth mode. Alright guys, I hope you enjoyed this video. Please hit the like button on this video, we'd super appreciate that. You can also support us further on Patreon at patreon.com/themarketisopen. Your support helps us to continue to make great content. Thank you guys so much for watching.